What is BILC? BILC stands for Business Investment Life Cycle. BILC is one of the tools used by MCM as one of the strategies to help investors to invest and diversify one's projects, especially in their business. Objective of BILC: MCM uses an approach by choosing to invest in a business with two main objectives, namely 1. Reduce risk by engaging in various industries. 2. Protect ourselves from potential falls or decline. Startup. This is the beginning stage where this stage is new, still rising and very risky. This stage is also said to be the birth stage of the business and the profits earned are still on the red scale. Therefore, business owners will usually focus all their resources to achieve stability because stability is the key in this stage. Growth. After going through the initial stage, this stage of growth is the stage where some things start to take their place and continue to rise. In this stage, the business will begin to earn consistent revenue and increase in customer network from a time that may occur due to word of mouth, content strategy, or occur naturally. Expansion. This stage is the stage where the business begins to expand. At this stage, business models will identify markets that suits them and will have to choose to scale with new definitions. Mature. When a business has gone through the previous three stages successfully, then the business has reached its maturity stage. Now, a business has gained the necessary stability and it's indirectly earning an annual profit. This is how the BILC framework works. Welcome to Max Capital Management Global Investment Community, GIC. What is GIC? Well, let's walk through it to understand it better. Part of our Corporate Social Responsibility, CSR, we found a global investment community on March 15, 2016. To give the community member the right knowledge about investing, be it whether you are about to invest now or later. Get ahead. Start in your investing education. A home filled with experienced investors that share their insights where you hardly find anywhere else. The main perks are inclusive, gaining the time and market-proven investment strategy, property investment life cycle, and business investment life cycle. It is learning from the experienced community members in various industries, learning various proven investment strategies, learning what is risk management and recovery strategy, learning why diversification is different industry and market are so important, access to global projects and businesses on top of it, a great team to support you all the way along. Here are the three main moves how MCM GIC can help you. Education, seminars and workshops has what the late Kofi Annan said, knowledge is power. Seminars are one of the best ways to get proper insights from experts in the investing world. Seminars provide you access to these experts so you can get a shortcut on what to learn and what to be aware of. MCM GIC holds almost 150 seminars globally every year, exclusive to GIC members. These include workshops, networking and site visits to connect with other members and project owners. By being a part of GIC community, members get a chance to understand the industry from the inside out and make wise decisions. Project management. Since 2012, Max Capital Management has always been providing project management consultancy to GIC members in the community with clarity. Members can easily do their project from a transparent perspective, which is reassuring. This includes investment vehicle, legal structures, tax and other aspects related to risk. On another hand, caters to wide-ranging project due diligence performance from sourcing, management, existing, sharing ecosystem to help GIC members with their investing journey. As they learn, MCM GIC has sharing economy to help maximum usage of resources. Max Capital Management has realized that there are inefficiency in the market and sometimes things can get unstable. Individuals may not be able to access to the right resources and resources may not be efficiently used. This is where the ecosystem comes in. Partners get connected with resources and members get maximum value being in the system. It always feels homely and safe to be part of the community because sometimes there are always hidden stories that people talk about. This factor can affect and even prevent people from making the decision they want mainly because they may not align with the investing profile and what they really are looking for. To help you more, you may also learn inside experience from investors who love to get their hand on being part of. The MCM GIC can give you access to such insights. Join the community today. Our help desk ready to serve you.
Hello everyone, my name is Yimin. Thank you for joining me today. What are some of the most common questions that an investor will ask before he or she decide to invest in a private company? Apart from what is the return on investment, the other frequently asked question will be, what is the exit strategy of that company? Exit strategies are planned executed by the business owner, the investor, trader, or venture capitalist to liquidate their position in a financial asset upon meeting certain criteria. And an exit plan is how an investor plans to get out of an investment. The exit decision is one of the most important decisions in the life of a private firm, since it typically allows the firm to access to public capital market for the first time. Further, it is the first significant opportunity for the entrepreneur or also the venture capitalist to liquidate some of their holdings in the company. Of all the various exit strategy, one of the most attractive exit strategy for entrepreneurs and also investors is IPO, Initial Public Offering. Now, what is IPO? IPO meaning the private company go public in order to generate capital to help further on their growth, to reduce debt, or to fund other business opportunity. IPO will allow the private equity investor to exit by selling its stakes through the share market. Now, let's talk about the advantages of IPO to investor. Generally, greater company valuation may be achieved for shareholders through an IPO compared to other exit strategy. You will have an advantage over other traders or investors who will enter the stock when it is launched on the market if you enter earlier. If an IPO, the largest number of buyers competing to buy the stock will definitely drive up the stock price and transfer the value to the investor. When a private company might have a lengthy search for a buyer or investor, public company investor can simply offer their share for sales on the public market with nearly instant results. Typically, the share price tends to change rapidly on the listing date itself. So if you anticipate the stock price will shoot up on the listing day, you can cash in on the listing gain by using the IPO's exit strategy called flipping. Flipping is the process of acquiring share in an IPO and then selling them immediately on the listing date, which is the very first day of the shares are being traded publicly. However, market regulator and also experts tend to advise against adopting this strategy because if the significant numbers of investors practice flipping, it will definitely pull down the share price. If you expect that the shares in an upcoming new IPO will perform well over the years, it may be a better idea for you to hold it in your portfolio for a few years rather than flip it on the listing date. This is a long-term exit strategy that you can also known as buy and hold strategy. It works best for the shares that are fundamentally strong and perhaps undervalued. If the investor hold the share long enough, there is a higher possibility to enjoy a higher return as public company can have a significant advantage in hiring and also retaining high quality employees to drive for better financial performance and ultimately drive up the share price. There are also cases where some companies are being acquired within a short period of time after IPO, and this will give a higher return to the investor based on the company valuation when the acquisition took place. Keep in mind, if you adopt this exit strategy from an upcoming IPO, you will have to account for a longer capital gain and, of course, the tax that will follow. Now, let's discuss about the disadvantages of this exit strategy to investor. Before deciding to go public, company must evaluate all the potential advantages and also disadvantages that will arise. The IPO process is a complex and complicated process. The amount of time it takes depending on many factors, and these could have potentially divert the company executive attention away from their core business, and profit might suffer as a result. If the team managing a IPO is well organized, typically it will take about 6 to 9 months for the company to complete its public debut. But I have also personally seen cases where it takes longer than 3 years to reach IPO status. The transition from a private to a public company is a very demanding process, and it will incur a lot of expenses for the issuing company. So this will definitely lead to a longer payback period to the investor. And after the IPO, typically the private investor will sell their share that they have decided to divest. And such sales often will trigger a fall in the share price after the lock-in period expired. So share price may eventually recover following a good performance by the company and reach a new normal. Although IPO are regarded as the safest and also the most advantageous method of investment, and however, this is not always the case. Investors should bear in mind that the risk behind of every investment, and as there's no guarantee that the impact from the other external factor could lead to a drastic fall in a share price. And many IPOs often fail to deliver their pre-launch promises. Just to share that recently, the ratio of acquisition of private company to IPO has increased dramatically. Over the last decade, a private firm are more likely to be acquired than going for public. So in summary, an IPO can serve as an exit strategy for a private investor. Such sales often return huge profit, with return many times bigger than the initial investment. But the private investor can still hold on to a part of the private equity and thus have a stake in the company. The downside would be an IPO process is very complicated and the amount of time to get to the return is longer, and there is no guarantee that the impact from other external factors might lead to a drastic fall in the share price. So always set your own risk appetite, conduct proper risk management, and be wise before you invest. Thank you for joining me today. Bye-bye.